All right, as I mentioned, this is the July 26th edition of Office Hours. My name is Dr. Tisa Silver Kennedy, and I'm the founder and director of the Maryland Center for Collegiate Financial Wellness, also known as MCFU. Before we get into the questions that have come in from our community, I just wanted to give you a brief overview of the center, tell you a bit about this program, which is Office Hours, and then we'll dive into the questions that have come in from our community, and we have quite a few. So, the Maryland Center for Collegiate Financial Wellness was founded in 2021 with a vision for all college career school students in the state of Maryland to have the opportunity to achieve these 6 pillars of collegiate financial wellness, those being creditworthy, ready, resilient, empowered, successful, and thriving. If you'd like more information about the vision and the mission of the center, you can visit us online at mccfw.org to learn more about our programs and events and for different ways that you can support. Now, Office Hours is our free semi-monthly virtual student loan clinic that provides borrowers with a trusted venue to help them navigate student loans and prepare for financial success beyond repayment. Now, right before I get into the questions that have come in, I just want to say that Office Hours is presented for informational purposes only. It should not be construed as personal, financial, or legal advice. Everyone's student loan portfolio is different, and everyone's path to that zero balance is different as well. So it's important that you take in information from reliable sources, such as your lender, your services, along with the Maryland Center for Collegiate Financial Wellness, and also take into account your personal financial circumstances, your household, your goals, and your preferences. And once you have all of that information considered, then you'll be in a place to make a more informed decision about any next steps regarding your student loans. So now that that's out of the way, I'll jump to the first question, and this has to do with rejection. The question is, I tried to consolidate my loans in April, and the application was denied because I was in school. I tried to apply again, and the website said I had an application already and needed to contact the servicer. How can I apply again? So with consolidation applications, if you are in school and attempting to consolidate, if you include loans that are in an in-school deferment, then that can cause the application to be denied. And that's what happened to this borrower. So we got on the phone, called the servicer, and the servicer instructed us to have the borrower complete the paper application because the online application on studentaid.gov kind of had this borrower in a situation where they were locked out. So the paper application is the only alternative for now, and that's available for download on studentaid.gov. So if you submitted an application recently, I believe within the past 6 months, and you're currently unable to complete that online application, you can download the paper application by going to studentaid.gov, and then on the loan repayment menu, you want to select consolidate loans. That usually takes you to the starting place of the online application, but if you scroll down just a bit lower, you'll see some links on the lower left-hand side, such as the link to the actual paper application, as well as instructions, and you will need the instructions to complete the paper version. Furthermore, for each loan that you are attempting to consolidate, you're going to need the following information. The first item is the loan code. The second item is the servicer's name and address. You'll also need the loan account number, which can be found through your servicer, as well as the estimated payoff amount. And if you have to end up completing this application by way of paper, I want you to keep in mind that the consolidation application process is one thing, the repayment plan request is a totally different thing. When you're able to consolidate your loans online, the repayment request piece is included within that online application. But once you have to step into that realm of paper, then you have 2 applications to complete, one for the actual consolidation, the other to request your repayment plan for the consolidation loan. So things can get a little bit more tricky. Here's something else I learned, and this is from meeting this particular borrower earlier today. So when you're filling out that consolidation application, the paper version, it's like a table where you have to put in the loan code, the servicer's information, the account number from the servicer, as well as the estimated payoff amount. Sometimes when it comes to these servicer websites, that information is not located all in one place, so we had to do a little bit of digging. And the first area where we had to do some deep digging was with these loan codes, because I know for many of you who attended before, you hear me talk about loan types. The loan type is really the name of the loan. It could be a FFELP loan, a direct loan, subsidized, unsubsidized, etc. But the loan code is something totally different. The loan code is actually a letter that corresponds with the type of loan that the person has. So for the borrower that I met with today, I think this borrower had like 13 or 14 different loans. So we had to look at each of the loans, find out the loan type, and then come back to this chart that you see and line up the type of loan with the loan code to then go ahead and put that in the paper consolidation application. So for all of those loans, we got the loan code. The account number, thankfully, was the same for all of the loans, so that was a lot less work. But we also had to do some digging when it came to figuring out the estimated payoff amount, because on this particular servicer's website, they broke out the outstanding principal balance, the accrued interest, as well as the capitalized interest. And so we did a little bit of math, found out the amount that has to be included is the outstanding principal, as well as the accrued interest. So I'm going through all of this with you so that you can see why the paper application is the least preferred method to consolidate. And if you are able to consolidate, you want to make sure that you use studentaid.gov instead of trying to go through this paper application. It's not that it cannot be done, it's just that it is much more difficult, and it opens up more opportunities for you to make mistakes that could lead to delays in your application being processed or the application being rejected altogether. So for this particular borrower, we are piecing together this paper application. We're going to send that in, and then we're going to reconnect to fill out their repayment plan request application. And then once they start working in their new government job, we're going to get back together and fill out their PSLF application. So multiple steps to get on the right path. But hopefully, if you are thinking about consolidating or applying for PSLF, you will have viewed this and said, you know what, I want to go online and do everything I possibly can through the website, which is studentaid.gov, where you can find all of these applications. Everything is online for free, and you can complete it at any time. Before I get into this question, I just wanted to make sure everyone knows it's okay to go in the Q&A. If I'm talking about something completely unrelated to whatever your question is, that's just fine. Just pop right into the Q&A, leave your question, and once I see something pop up, I'll stop and make sure that I do my best to address it. So let's move on to our second question, which is focused on repayment, particularly this new income-driven repayment plan that's called SAVE. So we had a question from a borrower who heard about the SAVE plan and they want to sign up before repayment starts, but they can't find it online. And their question is, how can I get enrolled? So the SAVE plan, first I want to tell you what SAVE stands for. That is Saving on a Valuable Education. And that is a new income-driven repayment plan that has been announced by the Biden administration. Now, as of today, if you log on to studentaid.gov and you go through the loan simulator or even try to request a repayment plan, you're not going to see SAVE listed there. SAVE is supposed to be rolled out this year, starting this summer, and additional benefits are going to follow in 2024. So for now, if you're interested in SAVE, there's really, there's no way that you're going to go and enroll in that particular repayment plan. But according to the Department of Education, any borrowers who have signed up for the current revised pay-as-you-earn plan will automatically be enrolled in SAVE. So right now, if you're in that plan, there is no action to take on your part. You should be automatically switched over to SAVE. So don't be afraid if you log on to studentaid.gov and SAVE is not there. It looks the same for everybody. This is completely new. It has yet to be fully implemented. So you're not going to find it, but it is there. And according to the Department of Education, if you are signed up for repay right now, you will automatically be enrolled in SAVE. And for those of you who have heard about SAVE but don't know exactly what it is and what the benefits are, I just wanted to share some of those with you. SAVE is a new income-driven repayment plan that's meant to be more affordable. And there are a couple of ways that it results in a lower monthly payment than the current income available. The first way is that it increases the income exemption from 150% to 225% of the poverty line. In layman's terms, this means that more of your income is protected from being considered as available to put towards your student loan payment each month. For the longest time, these income-driven repayment plans have looked at 150% of the poverty line as kind of like the base. Anything above 150% of the poverty line, they would take a percentage of that and consider it as available to go towards your student loan payment each month. So by moving that line from 150% up to 225% of the poverty line, they're basically protecting more of your income. More of the income can be kept for you as opposed to being considered as available to go towards your student loan payment. The second thing that it does, and this is a big deal, it is supposed to eliminate 100% of remaining interest for both subsidized and unsubsidized loans after a scheduled payment is made under the SAVE plan. This is a huge deal because many people who have been paying through these income-driven repayment plans have monthly payments that are so low that they're never attacking the principal balance on the loan. So in this example, if you have $50 in interest accumulating each month, but your payment is only $30, that means that there's another $20 of interest that's going to continue to sit out there. And if you keep on making that $30 payment each month, you're going to have another $20 of interest that's accruing each month. And if that continues, what happens is, even as you're making those payments as promised, on time, in full, you're not going to see your balance go down. Instead, you're going to see your balance go up because the size of your payment is not great enough to cover the interest. And if it never covers the interest, it's never going to have a chance of touching the principal. And that's why your balance will continue to grow. There are many, many people who have found themselves in this situation and have basically ended up paying on student loans under income-driven repayment plans for longer than they were supposed to. All of these income-driven repayment plans have a cancellation provision that's supposed to kick in after a borrower has been in repayment for either 20 or 25 years, but that hasn't been happening for a variety of reasons. So if you're in one of those income-driven plans and you keep making your payments, but you're seeing the balance rise instead of drop, you're not alone. That's just what happens when your payment is so low that it does not cover the accumulated interest each month. This particular plan is supposed to eliminate that remaining interest. So instead of seeing your balance rise, you'll see that that interest is no longer due. So that's a really big deal to get rid of all of that accumulated interest. Also, for married people, the SAVE plan excludes spousal income for borrowers who are married and file separately. Now, this is an option for certain repayment plans, but there are other plans that will consider your spouse's income as available to go towards your student loan payment, even if you have filed your taxes separately. But this SAVE plan would make sure that basically you can have your income over here, your spouse's income can be over there. And when it comes to calculating your student loan payment, your spouse's income will not be considered. This is something that I have seen get particularly complicated, especially when you have spouses where one person makes a lot more than the other, or you have one person who has much more in student loans than the other, or the other person doesn't have student loans at all. When people have similar incomes and similar levels of loans, it's no big deal. But when the debt or the income is lopsided, that's when you can have things get pretty complicated. Another thing that's pretty complicated here is this concept of cosigning. If you look at the explanation next to this whole, exclusion of spousal income for people who file separately, it says, this change removes the need for your spouse to cosign your IDR application. A lot of people hear the word cosign, and rightfully so, they assume that it means that they're actually taking responsibility for the debt. But this word cosign does not have its traditional meaning when it comes to an IDR application. When your spouse is asked to cosign your IDR application, that just means that they are signing to verify that the information you've included in that application is true. They are in no way accepting responsibility for the debt. They are not signing up to make payments. They're simply signing the application to basically attest to what you've said in the application as being true. And as many times as I tell people this, some people, their spouses just say, I'm not signing it. I don't want anything to do with this. I hear what you're saying, but the word cosign, whenever I see that, that means I'm signing up to take on some debt and I refuse to sign it. And when a spouse refuses to sign this application, that could make it so that the person with the student loans is unable to enroll in an income-driven repayment plan. So by filing taxes separately, if you're enrolled in this SAVE plan, your spouse's income will be kept separately when it comes time to calculate your student loan payment. So that's definitely a significant benefit. All right. There are other changes that will come along with this SAVE plan in 2024. I don't want to go through all of these, but I do want to point out the one here about borrowers with an original principal balance of $20,000 or less, and how they will receive forgiveness of any remaining balance after making 10 years of payments. It says with the maximum repayment period before forgiveness rising by 1 year for every additional $1,000 borrowed. So this is particularly aimed at people who have taken out relatively low amounts of payments. Also, something that I think could be even bigger has to do with the next point, and that's about consolidation. It says borrowers who consolidate will not lose progress toward forgiveness. Instead, they'll receive credit for a weighted average of payments that count toward forgiveness based on the principal balance of the loans being consolidated. This is important because prior to this income-driven repayment adjustment and prior to the limited PSLF waiver, if a borrower consolidated their loan, they would lose all progress toward loan forgiveness. So if they were applying for public service loan forgiveness and had already had some qualifying payments made, consolidation would wipe all of those payments out. If they were looking at income-driven repayment, they would be starting fresh. Their repayment history prior to consolidation would not count at all. During the limited waiver and during the IDR adjustment, the period that we're in right now, if you consolidate, you don't lose that repayment history. What they're actually allowing you to do is have the repayment history of the oldest loan in your portfolio applied to the entire consolidation loan. So it's much more generous than previous circumstances. But after this IDR adjustment period runs out at the end of this year, they're going to move to this weighted average of payments formula to figure out how much credit people can keep toward loan forgiveness. So a lot of changes are happening. I have shared, these screenshots straight from the Department of Education for you because we've seen, what's supposed to happen in theory, but because this plan, the implementation of this plan is forthcoming, I haven't seen what this looks like in practice. And until I see what it looks like in practice, I can't tell you what this really looks like, okay? So we know what's supposed to happen. As it begins to happen, I'll have more to report, but it looks like there's some pretty significant changes on the horizon that will make payments more affordable and more convenient for many people. All right, let's move on to our next question. This also has to do with income-driven repayment plans. The question is, I'm moving from Maryland to Georgia. I use the loan simulator and my payments are exactly the same in both states. What difference does it make? Personal opinion, you should stay here in Maryland, but since you're moving to Georgia, I'm going to go ahead and answer your question. In terms of income-driven repayment plan, there is no difference between the payment required of a Maryland resident or a Georgia resident. The only differences that you'll see if you use the loan simulator and you change states, those differences can be found in Hawaii and Alaska. And those differences have to do with the cost of living in those areas. So in this example, I just made up somebody, Jay, a single taxpayer who has an adjusted gross income of $50,000 and also has $45,000 in direct unsubsidized loans. So based on Jay being single with that balance of debt as well as a $50,000 adjusted gross income, I ran some numbers on the revised pay-as-you-earn repayment plan. And it's important to note with these income-driven repayment plans that the payment that you see first, that is the payment that is estimated for the first 12 months of repayment. Every 12 months, you have to provide information about your tax filing status, your adjusted gross income, as well as your residence and how many people in your household. And those figures will be put into the formula to let you know what your payment will be for the next 12 months. And you keep on providing answers every 12 months through a process that's called recertification. So the payments that you see here are the payments for year number 1 under the revised pay-as-you-earn plan for Jay based on that AGI and tax filing status. So in Maryland and Georgia, you'll notice that Jay would be required to make a payment of $397 per month. So the move to Georgia will not make a difference in the student loan payment. But if Jay were to move to Hawaii, that payment would drop to $221 per month. If Jay moved to Alaska, the payment would be $204 per month. So folks in Hawaii and Alaska have, I would say, significantly lower payments required from income-driven repayment plans, but for the other states, there is no difference. All right, let's move on to our next question here. Shifting gears a little bit onto a Parent PLUS loan. Question is, I have a Parent PLUS loan from Navient from 1997, and the parent wants to know, can this loan get forgiven by way of the IDR adjustment? Now, a Parent PLUS loan from 1997, I assume that this is not a direct loan, and I have connected with this borrower and confirmed that the loan is not a direct loan. This is a FFELP Parent PLUS loan. But in terms of whether forgiveness is an option through the income-driven repayment adjustment or the IDR adjustment, it really depends on your loan type. If you have commercially held loans, in this case, it's commercially held Parent PLUS loan, that loan must be consolidated into the direct loan program if you want it to be considered for the IDR adjustment. Also, if you're looking at public service loan forgiveness, that loan has to be consolidated into the direct loan program or it will not be considered. So if you have commercially held loans, you will not be considered for the IDR adjustment or public service loan forgiveness until after you consolidate the loans into the direct loan program. Now, if you have federally held loans, that could be Parent PLUS loans or other loans that you might have taken out for your own education, for the IDR adjustment, because those loans are federally held, they will be considered. So you will receive a payment count. But if you're interested in public service loan forgiveness, you would have to consolidate those loans if they're not direct. You would have to consolidate them into the direct loan program so that you can gain credit toward public service loan forgiveness. Now, this is a very big deal for Parent PLUS loan borrowers because prior to the IDR adjustment, Parent PLUS loans did not qualify for cancellation unless they were consolidated into the direct loan program. Furthermore, there's only one repayment plan that's available to borrowers who have Parent PLUS loans that want to pay through an income-driven repayment plan. That plan is called income contingent repayment. So for a parent to get on track, they would have to take those loans, consolidate them into the direct loan program, and they would lose credit for any payments they made prior to that. After the consolidation, they would then start making progress toward income-driven repayment or PSLF only if they had enrolled in the income contingent repayment plan. So a few hurdles there for Parent PLUS loan borrowers. But right now, during this IDR adjustment that is set to end after December 31st, 2023, Parent PLUS loans can gain credit toward income-driven repayment as well as public service loan forgiveness. You just want to make sure that if you have the commercially held types of loans, that you consolidate them into the direct loan program through studentaid.gov so that they can get on track for cancellation through either income-driven repayment or public service loan forgiveness. Now, for those of you who might have Parent PLUS loans and are not looking at public service loan forgiveness, Parent PLUS loans require 25 years of repayment history for them to be canceled by way of income-driven repayment. So for this particular borrower, they are very close. They might have already crossed the finish line. Now, this is a FFELP Parent PLUS loan. So this borrower had to consolidate and has completed the application to do so. The disbursement date on their Parent PLUS loan was September of 1997. So we're basically coming up on 26 years. This September will be 26 years since this loan was disbursed. Right now, the loan has an estimated payoff date of 2033. So that's another 10 years from now. If this Parent PLUS loan borrower had decided that they just wanted to leave the Parent PLUS loan, the way that it is, or the way that it was as a FFELP Parent PLUS loan, they would not gain any credit through the income-driven repayment adjustment. And they would just have to keep on making payments on the loan. As long as they paid on time and in full for the next 10 years, we'd expect that that loan would be paid off in 2033. Now, we project that with the income-driven repayment adjustment, this person would consolidate the FFELP Parent PLUS loan into the direct loan program. They would apply for an income-driven repayment plan just to make sure that once repayment resumes, their future payments will count toward IDR. In October, once payments resume, they will begin to make their payments using that income-driven repayment plan. Next year, mostly everyone with federally held loans is expected to receive an IDR payment count, excuse me. And if it's found that this borrower has had 25 years in repayment with certain forbearances and deferments counting as well, it's quite possible that this loan could be forgiven. And based on the guidance that the Department of Education has given about timing, if this person has reached the 25-year milestone by August 1st, so that's just a few days away, if they reach that 25-year milestone by August 1st, then this loan should be forgiven before repayment resumes in October. So I just want to share a bit more with you all about the milestone. So as I just said, if you reach the forgiveness milestone, that's 20 or 25 years. For Parent PLUS loans, it's 25 years. If you reach that milestone before August 1st of this year, the Department of Education expects to discharge your loans before student loan payments restart. And right now that restart date is set for October. If you reach the milestone on or after August 1st, they're saying that it's likely that you will have to start making payments after the payment pause ends, but not to worry, you'll get a refund for any payments beyond the number that you need for forgiveness. So if they found that you overpaid on the direct loan, then you would get a refund. So August 1st is coming right up. We'll see what happens for some of our borrowers who have been in repayment for a long time and have consolidated or now in the direct loan program, and looking forward to getting a payment count through the IDR adjustment. All right, let's take a look at our next question. I saw the payment my servicer said is due and I can't make it. Will I go into default if I don't pay it? All right, the good news is with default, it takes more than missing one payment to go into default. Default is a state that you enter after you have missed payments for more than 270 days. So it takes at least 9 months to get to default. So if you missed your payment in October, you're not going to go into default just because you missed that payment. But before I answer the question, I just wanted to share with you how important it is to avoid default if you can, because default has some very far-reaching consequences. And these are according to federal student aid. The consequences of student loan default include, number one, your entire unpaid balance and any interest becomes due immediately. So if you were having trouble making that monthly payment, imagine if they said the entire balance is due right now. Number two, loss of eligibility for deferment or forbearance and the ability to choose a repayment plan. So that means that you have less freedom to choose a repayment plan that might be most feasible for you. Third consequence is the loss of eligibility for additional federal financial aid. So if you needed to go back to school and you did not have enough money to pay for it out of pocket, you would not be able to apply for additional federal financial aid to help with those costs. Fourth, and this is quite damaging, the default will be reported to credit bureaus. This would damage your credit rating and affect your ability to borrow. When something negative like default hits your credit report, if you go to apply for a mortgage or a car loan, you may find that the lender will not lend to you at all. Or if you find a lender who is willing to give you a loan, you might see a really high interest rate or some very expensive terms. So the reporting to the credit bureaus can basically make everything else in life where loans are concerned more expensive or harder for you to obtain, period. The fifth consequence is your tax refunds and federal benefits may be withheld. Six is that your wages can be garnished. So the money can be taken before you can even, have a chance to spend it. Next is you could be subject to legal action, such as, a judgment, which would lead to the garnishment of your wages potentially. You would also become responsible for court costs, collection fees, attorney's fees, and other costs associated with the collections process, just making this more and more expensive. And finally, your school may withhold your academic transcript. And for some people, this withholding of the academic transcript, this is something that, some people say, oh, that's not that big of a deal, but it could be if the job that you're applying for is requiring you to submit an official copy of your transcript, one that you'd have to go through the school to get. So if the school withholds your transcript, you can't provide something that's necessary to apply for a job. And of course, not being able to get a job is not going to put you in a position to be able to get back into good standing with the debt. So remember, default comes after you've missed payments for 9 months. We want to keep you from getting into default in the first place so that you can avoid all of these consequences. So back to the original question, which was, I saw the payment my servicer said is due and I can't afford it. The good news is you have options. You can always contact your servicer and ask them for options to give you a bit more time or to select a more feasible repayment plan. But since we are coming out of an extraordinary circumstance here, basically a 3.5-year pause in student loan payments, the Department of Education has announced something that's called the on-ramp. And this is the description pulled from their website. For borrowers who still cannot make their payments, the U.S. Department of Education is creating a temporary on-ramp period over the next year that will help borrowers avoid the harshest consequences of missed, partial, or late payments. During that time, the missed, partial, or late payments will not lead to negative credit reporting, default, or loans being sent to collection agencies. So this is definitely a relief. If you can make payments, they're encouraging you to do so because technically your payments are due. It's just that during the on-ramp period, they're not going to enforce those harsh consequences. Also, if you miss payments, then those months will not count toward cancellation by way of the IDR adjustment, and those months will not count toward public service loan forgiveness either. So if you have to miss a payment, you want to make sure that you contact your servicer before you miss it. But just know that if you do miss it, then you will not get credit toward some of these one-time programs that are happening, like the IDR adjustment and the IDR adjustment that spills over into public service loan forgiveness. So for some people who have heard about the on-ramp and are thinking that, oh, it's just another extension of the payment pause, this is going to give me another year where I don't have to make payments, that is definitely not true. There are two key differences here. During the payment pause, payments were not required and interest did not accrue. During the on-ramp, interest will accrue, and interest is set to begin accruing in September. So if you do not make payments, interest will accrue and your balance of debt will grow. The second key difference, again, comes back to what happens with those missed payments. They will not count toward loan forgiveness under any of the income-driven repayment plans or public service loan forgiveness. So if you're able to make a payment, make a payment. If you are unable to make a payment, contact your servicer. You might want to explore the income-driven repayment plans or see what other options they have for you to keep you making progress that will count toward income-driven repayment and public service loan forgiveness if you have a career in public service. Also, repayment is coming soon. You can use the loan simulator online at studentaid.gov to take a look at all the repayment options that are available and contact your servicer before you miss the payment. If you're a person who has some of those older loans, the commercially held loans, I strongly encourage you to explore direct loan consolidation. With direct loans, you have access to additional repayment plans, and you could also get some credit toward that IDR adjustment in public service loan forgiveness, depending on your employment. If the loans stay commercially held, you will not get credit at all toward that IDR adjustment, and public service loan forgiveness would not be attainable either. All right, so speaking of public service loan forgiveness, we had another question come in which said, help, the PSLF application has changed. And yes, it has, but I'm happy to report that it has changed for the better. So before I show you the new application, I wanted to show you what the old application looks like. So the old application is here on your right. You'll see that it has 13 questions in section 3. There are so many ways that people can make mistakes by using the paper application, especially with this old version. Some of the most common mistakes are, number one, forgetting to put in the employer's federal employer ID number. That means the application could not be processed. Also, items number 5, 6, and 7, when it comes to employment, some people include a beginning date, but not the end date, or vice versa. Or if people are currently working for an employer, they forget to check the box that says still employed. Question number 9 has to do with whether your employer is a governmental organization. And what I've seen sometimes is that people think that their employer is a governmental organization, but it's really a nonprofit that might work with the government, or it's a nonprofit organization that they have confused with the government. So they checked the wrong box on question number 9. Also, question number 10, is your employer tax exempt under the Internal Revenue Code section 501c3? Sometimes people who work for the government will check yes for this box and no for the government box, and that causes the application to be rejected. Also, if you answer yes to question number 9, then questions 10 through 13 on this application should be blank, but sometimes people will answer 9, 10, 11, 12, and 13. And again, it causes their application to be rejected. And with a wait time on these applications, that's typically 3 to 4 months, a rejection like this can mean that you have to make more and more payments while your application is being evaluated, rejected, sent back to you for you to complete again. So the new application is definitely easier, but in any case, I strongly advise you to complete this application using the PSLF help tool. That's at studentaid.gov/PSLF, because when you fill it out using the help tool will use the employer's employer ID number to fill in a lot of the application for you. And then the only details that you have to enter are details about your employment status. So it just reduces the opportunities to make errors that can lead to your application being rejected. So what has changed about the application? Probably the most significant change in recent months has been the ability to have your employer sign the document electronically. The Department of Education is now using DocuSign, so that if you go to studentaid.gov/PSLF, you enter the employer's employer ID number and the details of your employment. You can provide the email address of someone from the organization. The Department of Education will send that form to your employer. The employer can sign it using DocuSign, and it will come back to the Department of Education, and then it will go to MOHELA. That means that you don't have to print this form out, physically go to an old employer, ask somebody to sign it, wait 2 weeks for them to sign it and let you know that it's ready. Go back, pick it up, then mail it by traditional mail to MOHELA and wonder if they received it. All of this can now be done by way of DocuSign. So if you are completing it for the first time, I would encourage you to reach out to your former employers, contact HR and ask if there's a particular person in that office or perhaps a generic email address for employment verifications. Get that address, confirm your employment dates, and then have this form sent over to them by the help tool by using studentaid.gov/PSLF. After the form has been sent to the employer, you can take a look behind the scenes within studentaid.gov. There's a section called My Activity. You can find out when the employer has signed the document. The employers are given 60 days to do it. So this is a great improvement from the old, you can start it online, but you have to print it out and do everything else manually. All of it can be completed 100% online through studentaid.gov/PSLF. Now, if you look at the new paper version, you will see that it has fewer questions. So now people won't mess up, selecting that their organization is the government when it's really a nonprofit and all of that stuff. This paper application flows in the same manner as the PSLF help tool. All you have to do is provide the employer's ID number, their name, their address, and then the details of your employment, which are very limited. Your starting and your end date, your status as full-time or part-time, and the average number of hours worked per week. If you have that information, then you can complete the PSLF application. So the application itself is not difficult. It's just that a lot of times when people try to do it on paper, they make mistakes that end up drawing the process out much longer than it has to be. So huge takeaway here is get the email address for somebody within the organization, have your employment details ready, and use the PSLF help tool to make this process as efficient as possible. All right, next we have get ready for repayment. And we're gonna share this in every edition of Office Hours until repayment resumes in October, because it has been 3.5 years. And those of us who are about to enter repayment again, we've gotta prepare for that adjustment back into life as we knew it prior to March of 2020. So What can you do to get ready? The first thing is for federal student loans, you want to log into studentaid.gov. There you can take inventory of your loans. You can also view your loan servicers. You can take a look at the repayment plan that your loans are currently enrolled in. And if that repayment plan does not look affordable, you can use the loan simulator to explore your options. You also want to make sure that your contact information within studentaid.gov is up to date, your phone number, email address, and mailing address. And you want to do the same thing for your loan servicer so that they have proper contact information for you. For those of you, again, who might have commercially held loans that were not included in the payment pause, there won't be an adjustment with those commercially held loans for you because they were never included in the payment pause. But if you have commercially held loans and federally held loans, and the federally held loans have been included in the pause, now you've got to get used to paying both of those loans, those sets of loans again. So if you just had commercial loans, there shouldn't be any adjustment. But if you have commercial loans and federally held loans, you got to make sure that you're making room in your budget to take care of both of those sets of loans. And if you have both types of loans, you might want to consolidate them, or at least consider consolidating them, so that you can get credit toward the IDR adjustment on the entire loan balance. Right now, commercially held loans would be left out. Your federally held loans will count. But if they're consolidated, then they will all be on track to get credit through the IDR adjustment. All right, so I always get questions about complaints. So I want to make sure that I share with you some options for accountability for student loan borrowers. One is the Consumer Financial Protection Bureau. You can visit them online at consumerfinance.gov to file a complaint. Also, the Department of Education has an ombudsman. The ombudsman is there to handle issues related to student loans, but it's very specific criteria around what constitutes something that rises to the level of the ombudsman dealing with it. So you want to make sure that you go to studentaid.gov, visit the ombudsman's page, and see if the concern that you have fits the bill for the types of problems that the ombudsman would look into resolving. If you have a complaint that's related to public service loan forgiveness, there is an option to submit a PSLF reconsideration request. This is a request that you would submit if you've received a payment count and you believe that that payment count is inaccurate, something's wrong with it. It could be worth submitting one of these requests, but it really depends on where your application is in the process. If you just recently consolidated and you got your first qualifying payment count and it's really low, that's not the time to submit a PSLF reconsideration request, because the way that the process has worked so far is that for people who've had loans, let's say for 20 years, they consolidate those loans to get on track for PSLF. Their very first payment count is based on the history of the consolidation loan only. So for someone who has had loans for 20 years but consolidated 2 months ago, their first payment count might be 2. And seeing 2 when you know you've paid for 20 years is quite alarming and would make you want to get, reconsidered. But the way that the process has worked so far is that the first count only includes the history of the consolidation loan. And then typically 2 to 5 weeks later, another count comes, and that count considers the entire history prior to consolidation. So if you just consolidated and received a low count, you might want to give it some more time before you submit a reconsideration request. If it's been a long time and you just have a payment count that looks ridiculously low, or you log on to Mohila and you see that repayment history is missing, then you might want to submit a PSLF reconsideration request so they can do some additional investigating and find out what's going on with that count. Now, on the state level, Maryland is a state that has its own student loan ombudsman through the Department of Labor, and the ombudsman can assist with problems including failure by the servicer to communicate with the borrower, errors in crediting principal and interest payments, misapplied payments, inaccurate interest rate calculation, billing errors, loan consolidation and modification errors, and or inappropriate collection activity or tactics. So you can visit the Maryland Student Loan Ombudsman online through the Department of Labor. If you're currently in repayment and you have a complaint, First, you want to make sure that you try to resolve it with the servicer, but if you don't get anywhere, please do visit the Maryland Student Loan Ombudsman online and file a complaint. Also, within the state of Maryland, student borrowers have a Bill of Rights, and that Bill of Rights includes the protections to which Maryland borrowers are entitled and the obligation of student loan servicers. You can find that information again on the state's Department of Labor website. All right, that does it for the questions that were submitted prior to the broadcast. So if you have any questions, please do drop them in the Q&A. I'm going to take a pause and look at the Facebook comments to see if we have any questions there. I think we're clear, and I'll hang on for a moment to see if any questions arise in the Q&A here on Zoom. You can visit our website at mccfw.org for more information about the center, our programs, events. And if you have a question, maybe you don't have one that's come to mind right at this moment, but if you have a question that comes to mind after this broadcast, you can visit us online at mccfw.org/contact. Fill out that contact form and we will make sure to get in touch with you. All right, I'm going to stop sharing and just hang out for a little bit longer to see if we have any questions that come in. And right now I see none. So we're good to go. I say this every time, but when I'm waiting in these last minutes, I feel like I need some background music or something. But thank you again for joining me for this edition of Office Hours. We host Office Hours semi-monthly, usually on Wednesday evenings at 7 p.m. Eastern Time. We take a look at the questions that have come in via social media, email, all of that, but we also answer questions or attempt to answer questions online for people to join the broadcast. So I see I've got a question that has come up. It says, will the IDR payment count consider other prior consolidations before 2010? And the answer is yes. The IDR adjustment actually considers repayment history starting in July of 1994. So if you consolidated multiple times, then all of that history will be included. I've worked with some people, for instance, I had one borrower just a couple of weeks ago who had a 2001 loan, but that 2001 loan was actually a FFELP consolidation loan that was dispersed in 2001. So they had taken out loans in the late 90s that were consolidated, and that consolidation loan was dispersed in 2001. So the history of that particular consolidation loan went back to 2001. But the history prior to the actual consolidation, the first consolidation, was from the late 90s. So my hope for that person is that they will have that debt canceled before repayment resumes, because we have the history after 2001, we have the history prior to 2001, and since they were only undergraduate loans, the threshold is 20 years in repayment. And from the late 90s up until now, we've definitely got more than 20 years of history there. So if you consolidated multiple times, that's okay. They're looking at the history going all the way back to July of 1994. And that's an excellent question. Thank you for submitting it. All right, I'll check Facebook again one more time. We are comment free, so I'm going to hang out a little bit longer. Like I said, if you have any questions that come up after this evening's broadcast, you can log on to mccfw.org/contact and submit a question. You can also keep up with us on social media. We are at the MCCFW on Facebook, Twitter, Instagram, and YouTube. And usually after these broadcasts, within about 48 to 72 hours, we upload the episodes to YouTube and we annotate them question by question. So you can go to the videos and hopefully find the content that answers the questions that you have. I see we've got another item that's popped up, so let me take a look. If I have undergrad and graduate loans, will the Department of Ed consider undergrad date first regarding the IDR payment count? Okay, so with undergraduate loans, the IDR adjustment, everything we've seen so far says that the period for forgiveness for undergraduate loans only is 20 years. And then For people who have graduate school loans and undergraduate loans, if those loans are consolidated, then the threshold jumps to 25 years. So if you know you've got history that goes back quite a ways, let's say like the person that I was just speaking of who had that 2001 loan, if they had that same 2001 loan, but they had gone back to graduate school in 2010, they could consolidate that 2001 loan and then the graduate school loans together. The consolidation loan would get history credited to match the 2001 loan. So if you have undergraduate loans and graduate loans that were taken out, they weren't taken out back to back, consolidation could put them onto the same clock, and those graduate school loans could basically get sped up to the pace of the undergrad loans. With consolidation, sometimes this could get a little bit tricky depending on when you took the loans out. For people who have those lengthy gaps, it's kind of, it's a no-brainer, because if you have a loan from 2001, you've already got more than 20 years of history with it. But if the loans are closer together, consolidation could still help, but it really depends on, to me, it depends on how much you owe. If you have a really large chunk of undergraduate loans and something very small for graduate, it could be that you want to let the undergraduate loans get forgiven by the IDR adjustment because the threshold is 20 years. Whereas if you combine that with the later loans, your threshold will go from 20 to 25 years because the graduate school loans are included. So for most people, I think consolidation is beneficial when you have an undergraduate batch and a graduate school batch. But for some people, I have seen situations where they've decided to just leave the undergraduate loans separate because the undergraduate loans might be already over that threshold necessary for forgiveness, whereas the graduate school loans are not closed. All right. We've got no open questions. I'm going to check Facebook one more time. And for the questions about consolidation, if you would like to get together and we could take a look at the consolidation to run the numbers and estimate how much credit you might have on the undergraduate loans and how much credit you have on the grad school loans, then please do reach out via mccfw.org/contact, and we can reach out to you and we could set up a consultation and take a look at those loans and help you make an informed decision. Okay. All right. 7:54, we've got about 6 minutes left. Y'all, please don't be mad at me if I don't hang out for these last 6 minutes. I'm gonna try though. All right, Facebook is still free of comments. And I don't see any more questions in the Zoom Q&A, so I'm going to get ready to wrap things up. I'd like to thank you for joining us for the July 26th edition of Office Hours presented by the Maryland Center for Collegiate Financial Wellness. My name is Dr. Tisa Silver Kennedy, and it's always a pleasure to be here answering your questions, trying my best to help you navigate student loan repayment and prepare for financial success beyond repayment. If you have any questions, please do visit us online at mccfw.org/contact. We'll make sure to get back to you. You can also join the conversation on social media by following us on Facebook, Instagram, Twitter, and YouTube. You can subscribe to our channel. We are at the MCCFW on all channels. And if the Q&A is clear, which for right now it is, I'm going to go ahead and end this episode. Until next time, be well, and I look forward to seeing you all in August. Bye-bye.